Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us discuss one question of estimated working capital where we have details of domestic market as well as export market. The adjustments are given in a question in such a way that they are a bit confusing. So we are required to read the question very carefully, do proper answer and estimate net working capital. Let us read question. Following information is submitted by Sairaj Chemist for the year 2013. Total domestic sales 2000 kg. Amount is given here rupees 4 lakhs. So we can calculate rate per kg 4 lakh divided by 2000. So it is at the rate of 200 per kg. Export sales 1000 kg. Total sales 1,80,000. We can calculate selling price. It is 180 per kg. Domestic cash sales 500 kgs. Here they have given total domestic sales 2000 kg. Here they say total domestic cash sales 500 kg. That means here the balance 1500 kg is on credit basis. Next, raw material cost for export sales rupees 60 per kg. For other sales, that is for domestic, rupees 50 per kg. Wages for all type of sales rupees 50 per kg. Total fixed expenses 20,000. Other variable expenses 80,000. For the year 2014, it is estimated as under: domestic sales will increase by 20%. It will go up by 20%, but average price shall decrease by 10%. Export realization will increase by 10%. Quantity sold will increase by 20%. Raw material prices for both will increase by 20%. Fixed expenses will increase by 80%. Variable expenses for domestic sales will be rupees 20 and rupees 30 per kg for export sales. This is information for 2014. Wages per unit will remain unchanged. It will be same as that of last year. Calculate working capital requirement for the year 2014 considering credit for export sales is 3 months. Domestic sales 2 months. This is information for debtors. Raw materials available on 1 month credit for both. This is information of creditors. This is information of current liabilities. Inventory of raw material 1 month for both. That is stock of raw materials. This is information of current asset. Inventory of finished goods 1.5 months for export and 1 month for domestic. This is information of current asset. Process time 1 month. This is information of stock of work in progress. Ratio of credit sales and cash sales will remain same. Wages are paid at the end of the month for full month. Fixed overheads are paid in advance for 1 month. This will become current asset. Cash required is 10% of gross working capital. Time lag in payment of variable expenses is 1 month. Let us do basic workings first. During current period, raw material cost for export as well as for domestic market they have given. For domestic it is rupees 50 per kg. Raw material prices for both will increase by 20%. So this is 50 rupees for current year. For estimated period, it will go up by 20%. So in 2014, for domestic purpose, raw material per unit will be rupees 60. Raw material cost for export sales, rupees 60 per kg. So for current year, in case of export, it is 60 rupees per unit. Raw material prices for both will increase by 20%. So this 60 rupees will go up by 20%. So 60 plus 20%, so it will be 72 rupees. 72 rupees per unit for projected 2014. Wages rupees 50 for all. Wages per unit will remain unchanged. That means for current period as well as for estimated period. Wage rate will be rupees 50 per unit. For domestic, current year 50. For 2014, it will be 50 rupees. In case of export sales, for current year 50. For projected 2014, same 50 rupees. Total fixed expenses, fixed overheads 20,000. Fixed overheads are rupees 20,000. This is for domestic as well as for export sales. So fixed overheads 20,000 are to be apportioned for domestic 2,000 kg and export 1,000 kg, that is total 3,000 kg. So it is per unit 6.6666. So it can be rounded off to 6.67. So in case of domestic market, in current year, per unit fixed overheads 6.67. In case of export market, for current year, per unit it will be 6.67. Fixed expenses will increase by 80%. This 20,000 plus 80%. 80% comes to 16,000. So 20,000 plus 16,000. Total it is 36,000. Domestic sales will increase by 20%. In case of export, quantity sold will increase by 20%. In case of domestic, 2,000 units for current year plus 20%. 20% comes to 400. So it will be 2,400 units. Export 1,000 plus 20%. 20% comes to 200. So it will be 1,200 units. total units 3600 units. We can calculate per unit fixed overheads. $36,000 divided by 3600, it is rupees 10 per unit. So fixed overheads estimated for 2014 per unit 10 rupees. In case of export also, it will be rupees 10 per unit. Other variable expenses for current period is 80,000. Other variable expenses rupees 80,000. Current year domestic output is 2000 kg, export is 1000, total it is 3000. To get per unit, we'll divide this by 3000. So it comes approximately 26 rupees 67 paise per unit. Variable overheads for current period 26 rupees 67 paise. In case of export, for current period 26 rupees 67 paise. Variable expenses for domestic sales will be rupees 20 and rupees 30 per kg for export sales. So this is the information given for the estimated period. For domestic, it is given rupees 20. For export market, it is given rupees 30. So we have calculated all per unit cost. We can add them to arrive at total cost per unit. For domestic sales for 2013 for current year, total cost per unit is 133 rupees 34 paise. For domestic sales, we have calculated selling price 200. Sale price per unit 200. We can find out profit as a balancing figure. So in case of domestic market for current year 2013, profit per unit is 66 rupees 66 paise. In case of export sales, current year price is 180. So in case of export market for current year 2013, per unit profit is 36 rupees 66 paise. Domestic sales will increase by 20%, but average price will decrease by 10%. So current price is 200, it will decrease by 10%. So it will become 180. So profit per unit for estimated 2014 in case of domestic sales, it will be 40 rupees per unit. Export realization will increase by 10%. That is, export price will rise by 10%. $180 plus 10%, it is $198. Here we got profit for export sales for 2014 per unit, it will be 36 rupees. What is as a balancing figure? So we have done basic workings Let us go for now calculation of estimated working capital. Inventory of raw material 1 month for both, that is for domestic as well as for export market. Average stock of material domestic 1 month. We have units per annum. We'll divide it by 12 to get per month units, multiplied by raw material rate, multiplied by period. For domestic market, for estimated period, raw material per unit is rupees 60. Units per annum 2400 divided by 12 multiplied by rate 60 multiplied by period of holding the stock 1 month, it is rupees 12,000. This will be part of current asset. Even in case of export market, period of holding raw material is 1 month. So same formula will have units per annum divided by 12 multiplied by rate multiplied by period. In case of export market, raw material per unit estimated at rupees 72. Units per annum 1200 divided by 12 multiplied by 72 multiplied by 1 month. It is 7200. This will be part of current asset. Process time 1 month. This is information of work in progress. In case of domestic market, raw material per unit is 60 rupees, wages 50 rupees, fixed overheads 10 rupees, variable overheads 20 rupees. In case of raw material, units per annum 2400 to get for month divided by 12 multiplied by rate per unit of raw material is 60 rupees multiplied by period of stock of work in progress 1 month, it comes to 12,000. Wages 50 rupees. Units per annum 2400 to get per month divided by 12 multiplied by rate 50 rupees multiplied by 50% multiplied by period 1 month. It comes 5,000. Variable overheads per unit 20 rupees. Units per annum 2400 to get per month divided by 12 multiplied by 20 rupees multiplied by 50% multiplied by period 1 month. Fixed overheads per unit 10 rupees. per annum 2400 units divided by 12 multiplied by rate 10 multiplied by 50% comes rupees 1000. Stock of work in progress for domestic market is 20,000. Now for export market, in case of export market, raw material estimated 72 rupees. Units per annum 1200 divided by 12 to get per month multiplied by rate 72 multiplied by period 1 month it comes to 7200. In case of all other expenses, we can have common formula units per annum divided by 12 multiplied by rate multiplied by 50% multiplied by period. Estimated wages 50 rupees. 1200 divided by 12 multiplied by 50 multiplied by 50% multiplied by 1 month. Variable overheads 30 rupees per unit. 1200 divided by 12 multiplied by 30 multiplied by 50% multiplied by 1. Fixed overheads rupees 10 per unit. 1200 divided by 12 multiplied by 10 multiplied by 50% multiplied by 1 month. So it comes to 11,700 average stock of work in progress for export market. This will be part of current asset. Inventory of finished goods 1.5 months for export and 1 month for domestic. Total cost for domestic market for 2014 is 140 rupees per unit. Period of holding stock 1 month. This 28,000 will be part of current asset. In case of export market, inventory of finished goods 1.5 months for export. In case of export market, total cost per unit estimated is 162 rupees. 1200 divided by 12 multiplied by 162 multiplied by period 1.5 months. it is 24,300. This will be part of current asset. Credit for export sales is 3 months. Export sale price is 198 units per annum, 1200. To get per month, divided by 12, multiplied by sale price 198, period of credit 3 months, multiplied by 3. 59,400 will be part of current asset. Domestic sales 2 months. Here they have said total domestic sales last year 2000 kg and domestic cash sales 500 kg. That means if we see the ratio of credit sales and cash sales is 500, credit sale is 1500. So 1500 is to 500. This is the ratio of credit sales and cash sales, which comes to 3:1. In other words, credit sales is 3/4 or 75%. Here they have said ratio of credit sales and cash sales remains same, that is 3/4 and 1/4. In case of domestic market, sale price is 180 units per annum, 2400, divided by 12, get per month, multiplied by sale price 180, multiplied by 3/4, indicating credit sales of 75% or 3/4, multiplied by period of credit. Period of credit, here they have given for domestic, it is domestic it is 2 months. So period is 2 months. It comes to 54,000. This will be part of current asset. Fixed overheads are paid in advance for 1 month. We have calculated estimated fixed overheads, which has increased 80%. The amount was 36,000. Fixed overheads per annum divided by 12 multiplied by period. Fixed overheads per annum 36,000. To get 1 month divided by 12. Advance payment for 1 month multiplied by 1. It comes to rupees 3,000. This will be part of current asset. Raw material available on 1 month credit for both. In case of domestic market, units per annum divided by 12 multiplied by rate multiplied by period of credit. Units per annum 2400 divided by 12 multiplied by rate 60 rupees multiplied by period of credit 1 month. In case of export market, units per annum 1200, to get per month divided by 12 multiplied by rate 72 multiplied by period of credit 1 month. So it is rupees 12,000. This will be part of current liability. In case of export, it is 7,200. This will be part of current liability. Wages are paid at the end of the month for full month. This is information of current liability. Wages estimated 50 rupees, and in case of export market also it is 50 rupees. Amount in arrears 1 month multiplied by 1 month. In case of domestic market, creditors for wages 10,000, it will be part of current liability. In case of export market, it will be 5,000, will be part of current liability. Time lag in payment of variable expenses 1 month. Variable overheads in case of domestic market 20 rupees, and in case of export market 30 rupees. Units per annum 2400 divided by 12 to get per month multiplied by rate 20 rupees multiplied by period of credit 1 month. In case of export, units 1200 divided by 12 multiplied by rate, that is given 30 rupees multiplied by period 1 month. In case of domestic market, it is rupees 4,000, that will be part of current liability. In case of export market, it will be rupees 3,000, part of current liability. We have calculated required values of current assets and current liabilities. Let us do final part of the solution, that is statement of estimated working capital. Sairaj Chemist, statement of estimated net working capital. To start with, first current assets, inventories, average stock of raw materials. Domestic 12,000, export 7,200. Average stock of work in progress, domestic 20,000, export 11,700. Average stock of finished goods, domestic 28,000, export 24,300. Debtors, export 59,400. Debtors, domestic market 54,000. Advance fixed overheads 3,000. Cash balance we are required to calculate. We'll have to do working note for that. Creditors for goods, domestic 12,000, export 7,200. Creditors for wages, domestic 10,000, export 5,000. Creditors for variable expenses, domestic 4,000, export 3,000. Cash required is 10% of gross working capital. After adding all current assets, here we get gross working capital. Of that gross working capital, we need 10% as cash balance. Total current asset is equal to gross working capital. We are required to take 10% of that amount as cash. Let us first calculate all these values. Current assets till cash is 2,19,600. We'll divide this by 90 and multiply it by 10. So it comes to cash balance 24,400. We'll add this to total current assets now. So gross working capital we have now 2,44,000. Total current liabilities 41,200. This will deduct from gross working capital. Estimated net working capital is 2,02,800. In this question, we have dealt with variety of adjustments. We can say that this question is revision of entire chapter. Do this question 2 to 4 times so that you will become perfect in this particular chapter. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.